the $50 million raise that bridges Wall Street and Main Street. This is by Rob Ellis, Horizontal Land Partners, and Midwest Residential Growth Fund 1. Real estate is worth more than all businesses in the United States combined by trillions. Think about that. Every company listed on Wall Street, every startup in Silicon Valley, every small business, together they're worth less than the homes that people live in. And for all the derivative swaps, the ETFs that finance has engineered, the number one form of collateral in the world is still equity in a single family home. That's why we're raising $50 million in equity to acquire $100 million in institutional grade single family home rentals, the same buy box that Wall Street has perfected since 2008. This is Horizontal Land Partners, and I'm Rob Ellis, operator, single family home builder, and founder of Midwest Residential Growth Fund 1. After 11 years of selling homes to institutions, it's time to never sell again. In 2008, firms like Blackstone, Invitation Homes, Pretium Partners, and American Homes for Rent, AMH, started quietly buying up homes while everyone else was panicking. They didn't flip them, they systematized them. Where I'm from, we ran some of the crews that worked with them. We sold a lot of the houses that worked with them. And a lot of those same funds adapt and change their strategies to get into different versions of the same thing. Single family attached with individual parcels. But in our markets, where I'm from in Columbus, Ohio, single family attached doesn't sell as well as detached does. Those portfolios became REITs, and real estate ETFs, Vanguard Real Estate ETF or VNQ, Fidelity REIT, Principal REIT, Principal Real Estate Fund, which is PGREX, Fundrise Flagship Fund, Heinz Global Income Trust, VGSLX, VNQI, and others. They turned the single family home into a structured, securitized, and institutionalized asset class. The SFR, or single family rental, was born. Even now, the biggest names are doubling down. Champion Homes, New York Stock Exchange SKY, has expanded its shares repurchase program to 150 million, signaling strong confidence in factory-built and attainable housing. Companies are sweeping and growing. We've looked at all the land development back where I'm from because we sell to a lot of them. And the best firms are owned by companies like Warren Buffett, and they sell homes under $250,000. Ryan Homes, nothing's changed. An affordable single family home is still the fastest selling asset class that's out there. We have the velocity and data analytics to prove it in any market. Starwood Capital invested $800 million into Houston submarkets and land, confirming that capital flows towards hard assets and coastal adjacent growth. Invitation Homes continues acquiring 200 to 400 homes per market, mostly single family homes, operating for operational density and scale. We've read every single one of their financial statements. We know all of their buy boxes. But the one thing that a lot of these firms have gotten away from is acquiring homes at a deep discount. Pretium and Progress Residential now manage more than 97,000 single-family home rentals, positioning themselves as one of the largest single-family rental operators in America. Fundrise has surpassed 1.2 billion AUM with more than 4,700 single-family home rentals, bringing crowd-funded real estate into the institutional spotlight. These aren't opinions, they're capital signals. Each one proves the same truth. Real estate remains the most trusted collateral in finance. We're structured like a real estate fund, not a brokerage. Under SEC Regulation D, Reg Rule 506C, We raise capital publicly, but only from verified, accredited investors, institutions, and individuals. Our goal is to deploy $50 million in equity to acquire $100 million in rent-ready, family-style homes across the Midwest and Gulf Coast corridor. We target 3-bed, 2-bath homes between 1,600 and 2,400 square feet first. Sometimes we come down to 900 to 1,200. I have the financial analytics to show that those actually outperform the larger homes at some of the bigger institutions. But the smallest that the biggest institutions purchase is around 1,200 square feet. We look for conventional construction, attached garages, rent-ready or light turn condition. We built 10 houses this year in Columbus, Ohio, some with no garages, some with 1-car garages, and some with 2-car garages. And the majority of individuals want a 2-car garage that's attached. Over 92% of single-family homes in my market where I'm from in Columbus, Ohio, are single-family detached. I used to convert multifamilies to condos, and that strategy never got me anywhere. We look for rent-ready or light turn condition homes located near jobs, schools, major infrastructure, especially Interstate 10. In addition, we take advantage of tax advantages such as investing in rural business or high unemployment areas where international investors are drawn to, and we've talked to raising capital outside of it. New York City raises capital in a lot of different ways, and we use the same strategies that they use, but for single-family homes. What kind of markets do these look like? Markets that we target or that we really like, every single day we talk to operators. I call real estate agents, wholesalers, flippers. We have a sales team down here. Tulsa, Oklahoma, Jackson, Mississippi, Lafayette and Baton Rouge, Louisiana, Mobile and Birmingham, Alabama, Pensacola and Panama City Beach, Florida, Montgomery, Alabama, Memphis, Tennessee, Beaumont, Texas, with reach into Brownsville, Corpus Christi, near SpaceX's Starbase. These are places where flippers can't flip, inventory builds, and buyers pricing power. And buyers gain pricing power because the typical financing, when you talk to a person that's a real estate agent down there, they're talking to me like, this will go FHA, this will go conventional, it needs $5K to do this. They're not expecting Wall Street to come in and buy homes at under $80,000 a piece. These are the same types of homes that I bought when I owned a home flipping franchise, We Buy Ugly Houses. I bought and sold more than 100 houses across the United States. It's the exact same buy box. We buy where homes trade under $200,000, sometimes between $80,000 to $150,000 with large value add opportunities, but rent ready means utilities were on in the last year, someone occupied it, and we can get that home up and running for less than $20,000. We prefer homes with no basements. Where I'm from in Ohio, basements ruined a lot of deals, but a lot of the times these still remain part of that, the best part. We prefer buyers markets with healthy rent to price ratios and housing under supply. Each metro offers Section 8 arbitrage, where government rent thresholds exceed current asking rents. That spread is our embedded hedge. Every day I talk to a flipper that's transitioning into rentals, someone that's trying to raise equity for the process is the same. They don't understand the technical financial indicators or how to structure economies of scale. But I've sold to billion-dollar firms for the last 8 years. I ran a nationwide demolition company and did projects across 20 different states: Nevada, Texas, Pennsylvania, Ohio, Michigan, Georgia, South Carolina, North Carolina, Tennessee, Miami, Florida, right? Florida was amazing. And there's so many people moving to those cities. there's an undersupply of affordable housing, or what we call commuter towns or bedroom communities. We're thinking in terms of yield distribution, not speculation. The difference between a fund and a flip is simple. One guesses and the other underwrites. Governance, this is the committee process that we drive. That's driven a lot of the single family home private investment funds that I've worked with for the last 11 years. Every acquisition flows through a committee-driven process, the same structure used by institutional allocators. No sight unseen deals, no buying at tax sales. Utilities must have been active in the last 12 months. Inspection reports will always be verified, and risk variables are scored. We underwrite it like a credit desk, not a wholesaler. It's not about me. You're not investing in Rob Ellis. You're investing in decision systems built on data, discipline, documented governance, and 15 plus years of Wall Street purchasing criteria. We analyzed over 1 million transactions from public records using AI scraping, computer vision, and data clustering to identify consistent undervaluation patterns. Every property we consider is graded on income to rent ratios, turn cost predictability, school district quality, employment proximity, regulatory, and HOA friction. Our goal is not speed, it's repeatability. That's how you compound returns without forecasting outcomes. Real estate remains an old school business. It's not something that technology can change. It's built on tradition, credibility, and trust. Our system uses AI-driven valuation models to pre-screen assets while our boots-on-ground teams perform analog verification. If a house fails the utility test, no power, no water, vacant, large holes in the floor, brand new roofs that are needed, cracking sidewalks and asphalt, we don't buy it. People still want to live in nice homes. That hasn't changed. This is as boring as it gets. If a neighborhood fails the velocity test, slow leasing, poor absorption, it's out. It's a hybrid approach that blends AI analytics with operator instinct. 2/3 of innovation is new technology, 1/3 is old wisdom. This is the macro context, real estate versus everything. At roughly $47 trillion, US residential real estate is worth more than the entire US stock market and all private businesses combined. Yet Wall Street still treats it as an alt asset. The gap is opportunity. The REIT ETFs, VNQ, VGSLX, VNQI, QREARX, Fidelity Real Estate Income Trust, Heinz Global Income Trust, Fundrise Flagship Fund, all exist because investors want exposure to the stability of housing. These are the top search terms, getting more than 5,000 search terms a month. If you want, I'll send you the keyword report that we pull every month that shows that accredited investors still want stability in single family homes. But they're broad instruments. Our fund gives focused exposure to single family rentals with committee level oversight and on the ground operations. We're buying from banks. We're buying properties. The average property that we look at was $120,000 6 months ago. It went through the foreclosure process, got listed with an REO agent or an asset manager, and now it's going for $65,000 to $75,000. That's what we try to buy as much as possible. And just like it did in Columbus, Ohio, the opportunity window goes away. When I studied finance in college at Ohio State University, we learned a concept called arbitrage. And there's something that says the market inefficiencies, where market inefficiencies exist, they will always be eliminated or go away. It's just free economics. It's not a new idea. This is the oldest collateral with the newest discipline. We buy in clusters, 200 to 400 homes per market, just like Invitation Homes does, because density equals efficiencies and operational scale. That's how we hire property managers. That's how we place tenants. That's how we lower the cost of doing business. In Dayton, Ohio, one of the biggest funds that I know, I believe it's Vinebrook. Vinebrook is in Dayton, right? They recently refinanced their entire portfolio and went through the entire, because they had to recap. Something that worked a long time ago doesn't always work today. How we deploy your capital. The way that we achieve economies of scale is without unnecessary risk. Our target portfolio with this fund is 1,000 homes across 8 to 10 metros, 100 million in aggregate asset value, low debt to equity ratios below 65%, just like I learned when I bought houses, because equity still wins. If the committee decides to go more, then we make that decision together. But for us, we have to be conservative, just like Wall Street always has been. 50 million in equity capital deployed. Conservative leverage to enhance a yield while maintaining optionality. We're not chasing appreciation, we're building permanence and cash flow first. Where I'm from in Columbus, Ohio, though, all the bedroom communities around it, after Columbus didn't have any more homes to buy and Wall Street came in and bought them all those secondary markets that had the average home values under 200,000 appreciated at more than 10% a year for 5 years plus. Places like Circleville, Ohio, Marion, Ohio, Bellefontaine, Ohio, the builders are already entering these spaces. For accredited individuals or companies, there's two ways for accreditation and for allocation. For individuals, the minimum investment is $250,000, designed for professionals, business owners, and experienced investors seeking exposure to real assets managed under institutional discipline. For qualified institutional buyers, or QIBs, this would be your family offices, your RIAs, Wall Street allocators, private equity, sovereign wealth funds, alt investment funds, crowdfunded raised platforms, funds of funds, $5 million to $10 million minimums, and that'll buy you a market exclusivity as well. If you want our #1 market right now, Tulsa, Oklahoma, it's yours. Write the check. Family offices and all these other alternative firms are still looking for the same industry. Down here in Miami, when I talk to Latin America, when you look at the condos behind me, the way that developers sell is by selling to international investors. We have the ability to access a massive market that's untapped in every other market in America that's only available to bilingual. Yo hablo español. Brickell's a new financial city center for the East, and there's a lot of New York money that's moving down here. They've always been paired well, really well. From my 10 years of selling real estate to out-of-state investors, the biggest investments always came from California, New York, Illinois, Chicago, Austin, Texas, Boston, Massachusetts, Toronto. I had to help people solve problems like, how do I invest if I don't have a green card? When I worked with individuals for a long time, it became really easy to solve any kind of problem. Verification is mandatory. We partner with third-party accreditation services for compliance integrity, like your accountant, to make sure that everything's done well. It's a two-step process that makes sure that we're safe and you are too. Self-accreditation and third-party verification before we even ever receive the funds that you want to allocate. We lower risk by design, not by defense. Our risk management philosophy is simple. No distress rehabs, rent-ready, habitable conditions from day one, or CapEx of less than $15,000. It's the same ones that apartment and multifamily investors have used for a long time. Geographic diversification, spread across multiple metros and states. Operational partnerships, vendor networks pre-qualified by scope and underwritten, just like the homes that we buy, with dedicated service areas. Governance structure, independent oversight, and documented controls. I'm not making the allocating decisions, a committee is. Every home is a micro contract, every city is a diversification node, and that's how we scale safely. If Starwood Capital spends $800 million in Houston, Texas, we don't compete, we complement. We take the same corridor, the same fundamentals, but we buy and execute where our buy box can enter. with higher velocity capital and smaller, lower risk strategies. That's called capital arbitrage, following institutional footsteps and footprints while fishing at retail depth. It's not about outspending the giants, it's about out-rotating them and how many times we can turn capital. If you're a Wall Street executive, you already hold Vanguard Real Estate ETF, Fidelity REIT Fund, VNQI or Fundrise. You understand portfolio construction and risk-adjusted yield. Our fund gives you direct exposure to the underlying collateral those instruments depend on. If you're a San Francisco investor, Los Angeles, New York, you know opportunity cost. You've seen tech multiples compress while tangible assets rise. Where I'm from, one of the biggest disruptor of the year, Anduril, never got a valuation round above $1 billion until they built the factories that employed more than 4,000 people where I'm from. And it's going to take them 7 years to build that out, that 5 million square feet out. This is exposure to something old, real, and permanent. Single-family homes in America's most consistent markets. The human equation. I sold houses for 11 years, hundreds of them, more than $15 million worth, more than 500 transactions. I bought and sold houses in a flipping franchise. I scaled nationally and did more than 150 contracts in demolition, strip outs. I ran painting contractors. I worked for affordable housing developers, the biggest across the country. And all of them work for the biggest billion-dollar firms. When we're taking out a old Kmart and putting in a new self-storage, that's the kind of decision-making that we want to take to a committee and decide together. I've seen families close on their first home. I've seen families lose their first home. I've seen institutional buyers close on hundreds in a day. But one truth always holds. The family home is America's most consistent asset. Where I'm from down here, for Latin Americans, for the Hispanic population, paying and owning a home in Miami is the only way to financial freedom. Now, instead of selling, we're owning forever. Nothing's for sale. We're raising $50 million in equity to purchase $100 million in institutional grade, single family real estate. We buy where others hesitate. We build portfolios the way Wall Street used to, through discipline, governance, and scale. But we do it with operator precision and strong sales. Real estate is America's foundation. We're just giving giant investors a way to own it like an institution. This is for accredited investors only, under the Reg D Rule 506C. It's for informational purposes only. It's not an offer to sell or solicit to buy a security. These offers are only made and solely through offering documents provided to verified, accredited investors, protected by vaults. Wall Street engineered the derivatives. We're buying the collateral. This is Horizontal Land Partners. This is our buy box. Thanks for watching.